like to thank everybody for joining us today. We have an exciting webinar with the topic Banking as a Service, what fintechs and banks need to know. I am your host, Brandy Reynolds with the Bates Group. I will turn it over now to your moderator, Robin Garrison. Thank you.
Hi, everyone. Thanks for joining us today. I'm going to go ahead and share my screen really quick. And we will get going. Okay. Again, thank you all for joining us today. I am Robin Garrison, Managing Consultant at the Bates Group. I have been in FinTech and BaaS for about 16 years at several FinTechs, a couple banks, large, small, and then working with a middleware provider. And I'm very excited to introduce you to our panel today. And I'm going to let them go ahead and give their own background. So first we have Dana Lawrence. You want to go ahead and introduce yourself?
Yeah, thanks so much for having us, Robin and Brandy and Bates Groups. My name is Dana Lawrence, and I've been in financial services for 20 years. I started, sorry, I was really close to the screen. I started in fintech in 2014, working at Simple, one of the first US neobanks. And then I continued that path working at Aslo, and then I led compliance at Scylla, which is a fintech aggregator. So I got some experience on that side. And then I recently joined Pacific West Bank and built out a bank fintech partnership program for them starting in 2022. So I'm super excited to be here and learn from the other panelists.
All right, thanks, Dana. We also have Brad Rustin from Nelson Mullins.
Hey guys, so I'm Brad Rustin. I chair the firm's financial regulatory and fintech practice. I've been doing banking law for about 20 years for both banks and non-bank financial services companies. And as part of that, we work with 2 or 3 dozen of the big fintech sponsor banks who back end lending and payment infrastructure. We also do a lot of corrective action work with the regulators, doing formal agreements and consent orders when things go wrong inside of the banks. And so I've been spending a lot of quality time with our friends in Washington, D.C. recently, helping them think about how BaaS and fintech and how that interplay is going to look over the next 4 to 8 years. So really looking forward to the discussion today and speaking with everybody.
All right, and last but not least, we have Eric Schneider from Kraken.
Hey y'all, Eric Schneider here. I've been in the finance industry for 30 some odd years, back when I used to have hair. There I started, and I worked at large companies such as banks at Citibank. I transitioned to fintech in 2014. So Dana, you and I did the exact same time. And then I subsequently transitioned from fintech into crypto in 2021, which further made me lose my hair, but made it incredibly interesting. Throughout this process, we were at a time where no one could even spell BaaS because it wasn't existent, to absolutely needing it. And this is where we are at Kraken, where we're intertwined with the companies, and we have some ideas and pros and cons to share with you as far as how best to do it.
I just have to pop in and say, before the webinar started, we were all chatting about working in the compliance field and its correspondence to prematurely aging. So,
All right. If anybody has any questions about that and our skincare routines, please feel free to drop it into the Q&A section of the webinar. All right. Well, without further ado, we're going to head in. We have quite an agenda for you today. We are going to go fairly fast. There's a lot to cover, but the goal today is to give you an idea of sort of where we come from, where we are, and where we're headed. All right. I'm sorry, I am not a pro at sharing my screen, so I will do my absolute best. All right, so before we get into some of the heavier topics, current state of BaaS, we all know that it's been a little bit rough the last couple of years. Right now, there's quite a bit of turmoil. We're not really sure on a couple issues, kind of which way is up, but compliance professionals, we're still pushing forward with best practices, trying to take some of the lessons learned from a lot of the consent orders that have come out, as well as some of the things that are not necessarily completely public, conversations with regulators. And there's just a lot of learnings. And to start us out, I would love to hear from Brad What are your thoughts? What's going on with, your clients? What are you seeing?
Yeah, great question, Robin, because fundamentally we haven't changed the economics of fintech partnerships, right? Fintech is still much more efficient at locating clients. Their customer acquisition costs are lower. Oftentimes they have better tech stacks, better user experience, better user interfaces than any financial institution does. But with that, obviously, comes that explosive growth that we saw over the last decade. And the regulators have started to push back on that, right? You open American Banker, and all you do is see headlines about consent orders, formal agreements, what have you, that are coming through these partnerships between banks and credit unions and then non-bank fintechs. In the last 6 months, though, I think the game has changed, right? We went from extreme focus, right, where we were having the OCC come into our financial institutions. They bring huge teams, they do very extensive examinations, to that same level of focus that we're seeing now. But I think the regulators are becoming more sophisticated, right? They're increasing scrutiny, but they're also learning what's good and what's bad. And they're starting to do a very good job differentiating financial institutions doing BaaS well from financial institutions that are doing BaaS poorly. The other interesting we've seen over the last few weeks is with particularly like SmartBiz getting their charter approved. We have seen a huge number of fintechs that are now trying to partner with financial institutions. And if you think about that, with the weakening of the CFPB, non-bank financial services companies, so state lenders, state payment, money transmitters, payments companies, are now stuck in kind of a purgatory of 50 different regulators, right? 49 different money transmitter licenses, 50 different lending licenses, some aggressive states, some less aggressive states. And they're looking to partner with financial institutions to get that regulatory scrutiny, to get that preemption, and try to unify their regulatory obligations. And so the number of fintechs that have been calling the fintech sponsor banks and credit unions in the last 6 weeks, I bet it's 10x what my clients are telling me over what it was at the end of 2024. So you've really seen explosive growth in the number of fintechs looking to partner right now.
Brett, if I could jump in on that, we're seeing the same thing from our side there. From an anecdotal standpoint, it's yes, I feel like we have gotten a lot more outreach at conferences. There are a lot more of offering. From a quantifiable standpoint, the figures that we've seen are around $30 billion in revenue is generated in BaaS last year. That's expected to grow 3 times by 2030 because of the new regulations in place and the weakening of the CFPB, which is both a pro and con, right? And so we see there are 136 BaaS providers supposedly around. I think each one of them has sent me an email to have an outreach, by the way. But we expect to see a lot more of those companies in the future, for both better and for worse, right?
And Eric, I think you make a really good point, which is we're also learning a lot more from the regulators in terms of those expectations. And Dane, I know when we were talking, you had mentioned a lot of what you've been monitoring in terms of those expectations of regulators and what we're seeing on those consent orders.
Yeah, so a lot has changed. We have a new administration, and obviously a lot has changed with regards to the CFPB and some changes in the leadership at FDIC. A lot of people are saying, well, do we still need to do compliance? Is this still going to be a focus? And I think it's really important to kind of reiterate what some of the top themes of consent orders were, just so that we can keep that in mind. Banks are still subject to regulation. Fintechs who partner with banks are still subject to the same laws that we were in 2024. So I think my point would be no matter which way the pendulum is swinging with regards to regulatory oversight or the political realm, it's still really important for a business, whether you're a banker or a fintech, to focus on having sound risk management. So some of the key themes and consolidated, I think, are around board governance. And the key takeaway there is, does your board actually understand what the fintech business is that you're engaging with? Do they really actually understand what the products are, what the risks are? Do they have some skin in the game? Because when you're a community bank or any type of bank or even a credit union, you're putting a lot on the line to partner with a fintech, anything with evolving technology. You have a lot to gain, but you're really putting a lot on the line and taking a lot of risk. So the importance of your board really understanding that will prevent issues in the long run. Another one of the top themes was regards to third-party risk management programs. And we've had regulation around third-party risk. I think, I was working on it back in 2013 and even before that. And now there's some, I think, pretty good interagency guidance. And anyone working in the space should read that from start to finish, reread it, familiarize yourself with all the aspects. It really boils down to how do you think about bringing on new partners, fintech partners? How do you identify what risks are presented, what type of due diligence you're doing, making sure you have a sound contract, an approval process, and then really paying attention throughout the lifetime of that partnership to make sure that things are being managed in an appropriate manner. And then my final point, and I know we have this slide with multiple different points on it, but I think the three most important would be the oversight from the board, the third-party risk management, and then the BSA AML risk. How I think about this is ensuring that your organization understands the specific BSA, AML, OFAC, and financial crime risks associated with the product type, with the end users, and then understanding all the controls from an applicant applying to having the KYC run to making those decisions, if there's any manual review. How is that customer risk rated? How is that maintained over the life cycle? How are the transactions monitored? Really the same basic principles that people know in banking need to be applied to a fintech, even though they're not necessarily that specific regulated entity. But again, it's just kind of thinking through all those little bits and pieces, and it can get complicated. So those are my top three picks for us to just focus on as we move forward.
Thank you.
Dana,
Oh,
go
Go ahead, Brad.
Dana, you make a good point. I think one thing I've been hearing recently, particularly from the OCC and the FDIC, is, and make sure that's customized and to the particular fintech, that they're getting real tired of seeing just kind of pattern policies, procedures, and controls. Make sure you're actually thinking about those relationships and all of those things you just flagged, making sure they're specific to the risk vectors of that particular relationship.
Yeah, because then it's not worth the paper that it's written on. It has to be specific and it has to be accurate.
This is that double-edged sword that we're seeing, right? In which, because of less regulation or more open structures, we're getting much more competition in this space. The disadvantage to that, though, is at least one of the trends that I've seen is a lot of these new entrants focus on the tech side of fintech, right? And so they have a beautiful interface and they have wonderful decks and they've got huge valuations in short periods of time. But Dana, to your point, I mean, it's so important to keep an eye on that financial side and the liability component of that third-party risk, because these are exposures that companies are taking, at least the way we see it. It's a potential exposure and a liability. Who's managing the financial component? And then how do we mitigate the risk component from any type of negative action that could come? How could that manage blowback on our side? So we're being very cautious on how to proceed with BaaS partners.
The the theme that I want to share with like literally everyone on this call, by the way, thank you. I see a lot of familiar names in the attendee list. Great to see everyone. The theme that I want to share on this call is, again, like that pendulum's going to swing. Sometimes the regulatory regime might seem more flexible, sometimes it might seem more conservative, but all the folks on the call, I'm sure a lot of the attendees, we've been through multiple economic cycles. I remember I started during the mortgage boom, and at that point in time, everyone was doing stated income, stated asset loans, which are called like liar loans. There are just a lot of very aggressive risk taking. And then that resulted in the huge economic collapse of the 2008s to 2011. It was really horrible. And then we think of, again, kind of like all this fintech starting to surge and thinking about, are we focusing on the tech or the fin? And And we saw kind of like the crisis of all the different crypto exchanges collapsing in 2022, which led to bank failures. And where I'm going with all this is not to kind of like paint a picture of doom and gloom, but just to kind of notice like history repeats itself. These are just, kind of shifts in a cycle. And we all have, I believe, a responsibility, if you choose to accept it, to kind of think through especially when you're at those companies where people really want to build something new, they want to build something quickly, they want to grow as fast as possible, being kind of the challenger or the adult in the room to think through what is the potential impact that this could have on a human, what could it have on our brand, what are the risks here that we might not be fully thinking through.
All really great stuff. And double tapping on what Dana's saying, this is a cycle. There's nothing new in banking and fintech. It just sometimes looks a little bit different, but we just stay the course. We know how to do this, right? We know how to do compliance. We know how to do risk management. All right. Well, I'm going to keep on moving on to cover all the rest of our material here. So I'd like to hear from all of our panelists about common compliance pitfalls in BaaS, because I think we're seeing, like we've mentioned, we're seeing a lot of patterns. I think, hearing stories from people, because we know that a lot is happening that isn't public, but everyone talks, we all kind of hear the same stories. There are some very concrete themes that are coming out of a lot of the challenges in BaaS, both positive and negative. But I'd love to hear from our panel, and Brad, I'd love to start with you and kind of go round the room, so to speak. Hear what you guys think about these particular pitfalls, if there's any that you feel are more important to talk about, what your experience is. But Brad, what do you think?
Help if I unmute myself. Let me talk briefly about some recent unpublished formal agreements that are in process with some fintech banks. The number one criticism is they got too siloed, right? Fintech can't exist as a fintech vertical in your financial institution, right? If you were to open a branch on Main Street in your hometown, you wouldn't keep BSA AML out of that process. You wouldn't keep credit risk out of that process. You wouldn't keep ops and retail out of that process. You need all of that expertise coming in and having an oversight of those fintech partnerships. There can't just be a fintech group within the bank, unless you're, a Big 10 bank with 500 people in that group. We see a lot of that problem with siloing. And then another thing, and to kind of ping on what Dana had said earlier, we're seeing fundamentals breaking down. Things like if you're going to run a payments program, make sure you've got good BSA AML controls. Make sure you have end-to-end identification of payments. You're complying with the travel rule for international transfers. Just basic kind of FFIEC blocking and tackling type of things. But we're seeing a lot of banks get caught up in that, and they're overly relying on the fintechs for that. And I think one of the things you've got to do is, as you're pricing these relationships as a financial institution, is make sure you can then price in the resources to build your own oversight and control of these relationships, and make sure it's responsive, right? I mean, we always talk about life cycling these. And the number one thing, and the OCC has been the leader on this, is they want us to have a formalized compliance management system for each fintech. That's going to start with the diligence, to risk assessments, to contract controls, to monitoring and testing programs, to end of life planning. And they want to see all of those matched together, and they want to see people signing off on those. I mean, I joke now, and then I'll kick it to the other panelists, that when we go to launch a new fintech, I make the bankers go around the room. It's like mission control to launch the space rocket. And I say, ACH, are you go? Are you signed off? Ops, you go. Data sec, are you go? Data integrity, go. BSAML, go. And I make them all put their name on the sheet, because if they don't feel comfortable putting their name on the sheet, we failed in that life cycle, right? We failed as the attorneys that were helping them, or we failed as a bank if you're not willing to put your name and say, launch the shuttle, right?
I love that approach. And Brad, that makes me think about documentation. And on the slide here, it says documentation gaps, but having that official sign-off process, it is an important piece of documentation that you're going to later present to your regulators. And when I think about preparing for exams, going through exams, I really think about everything I do. It should correspond to some piece of documentation because in 18 months, when I go through an exam, everything I've done is going to be scrutinized. And how is this going to look to someone 12 to 18 months after the fact with no context? Make sure your documentation represents all the good work you're doing. Make sure that documentation supports you during your exams and having, that it might just be like, okay, we're just going to do the go, no go. That's a huge control. Get that documented. And I mean, that's how I kind of like explain it to other team members. It's like we put a ton of effort into getting these rich committee packets, which we meet monthly for our fintech programs. We have it, a standing agenda. We talk about the ongoing monitoring of all of our fintechs, our financial metrics. Like we just have a really robust standing agenda. And then each month we're curating these rich packets. So the documentation, and again, it's like I don't think any compliance officer is ever going to be 100% perfect. We are human, but having like a kind of an attitude that we're going to have good compliance or good documentation can kind of just help. Um, I want to move to the bullet point that says lack of role clarity. I hear this coming up a lot, and this is something where I think there is an answer to. And how I think about this is for each new fintech we brought on, as part of our due diligence program, we have documented like a risk register, thinking through each different process. Who's taking the application, who's doing the disclosures, who's doing KYC, how is like literally in painstaking detail. But if you don't know who specifically is doing a task, if it's your fintech, who at your fintech, is it some other technology provider? Is it someone at your team? Literally assigning responsibility to every single step, putting those documented controls in place. And then if you've missed something, add it over time. If you find a control deficiency, you can update it in your system. And I have a GRC platform that I really enjoy using. So that's a way that I feel confident that I have a process in place to really map out that role clarity. And again, it's never going to be perfect, but we can keep it updated over time. And
And
then my
Dana, can I
final,
jump
oh,
in
go
for
ahead.
30 seconds on something you
Yeah,
just
yeah,
mentioned? Because the OCC said this to me last week, and I think it's important.
yeah.
It's okay to have failures.
100%.
Document that you followed up with the fintech, exactly what you're saying. You found
Mm-hmm.
the person responsible, you documented a corrective action plan, and it doesn't
Mm-hmm.
lead to a formal agreement and consent order. You don't have to do banking perfectly. You just got to
100%.
control it.
Yeah. And it's like, I think that, yeah, those self-identified compliance issues, that's healthy. Like they want to know that you catch it and that they can see in a documented manner that you are following up on it. You're escalating that activity if it's not being remediated up to the point of, parting ways or, what have you. My final note, and then I'll pass it on, is just tech-related risks. I think AI is going to be something that more people are using, and whether it's using AI to do a music playlist on Spotify, low risk, versus using an AI decision-making engine to underwrite loans and automate results, that's going to have more model validation requirements. But making sure that you are thinking through not only what your organization is using, but what your key partners are using, and that the governance extends to that. So I'll pass it off.
Well, spot on. Dana, Brad, you guys covered a lot of the key topics. I'll share a little bit about our experience as a user of banking as a service, companies, products, and all ourselves, right? And I think a lot of these compliance pitfalls start at the beginning, even before we go live. The first one is, and I've seen this at other companies, a senior executive gets excited by a presentation because it has great hype, according to it, right? So what about the compliance side, though? How does that part look? The second one is the compliance voice getting shouted out by the team who's saying, hey, but this is less expensive. I can save a few cents per transaction, which hits our bottom line. I think these are pitfalls where you say, that's super, but in case something goes wrong, the cost of that is sometimes insurmountable there, right? And so I think those are potential pitfalls to go through. Now, how do we mitigate things like this? Due diligence on the potential partners is essential, but Dana, you touched upon this too. Transaction monitoring afterwards, that's essential, right? And this is something that you don't just take a look at it and say, great, you have free reign, go live, let's see what we can do. It's that transaction monitoring throughout. The other piece, and you touched upon this too, Dana, but I think this is such an important one, the lack of role clarity. This should be clear in advance. And Brad, I took copious notes there because I like that idea of the team going and giving approvals around. Because that lack of role clarity, a lot of these contract negotiations care more about the due diligence process. That's done. What's the financial and how are we going to do this part? What about the role clarity? SLAs, for example, having that clear and then having tests in it. Because if you ask me, I think that the compliance team is going to be essential in doing the evaluation of these potential partners, but also making sure that when we roll this out, it's not binary of, yep, okay, let's go live in all 50 states with 100% of our client base. Let's do it in a phased approach. Let's make sure that this goes through. This comes down to SLAs and who does what. And if there's overlap in certain project, I'm not against that, right? The checks and balances and reviews. And also, I think that we should have reviews once we go live every few months, quarterly, let's say, have an idea of this is what we've identified, this is what we've seen, this is what we're working on, making sure that that's aligned with all the other partners because this isn't just done in isolation. You're dealing with a banking as a service provider, and that banking as a service provider usually has an underlying bank, and those trilateral discussions, I think, are essential to have. And Dana, I know that you mentioned about AI. Here's my thought process on it. And from managing a P&L, everyone's thinking, this is great. Can we replace everybody? Maybe the entire compliance and legal team with AI and we're set. Absolutely not. Right? This is a tool. I like the idea of Spotify. We can start there. But just like any tool, it needs data in order to go through. I don't think this is a matter of if, I think it's a matter of when AI is going to be relevant. I don't think it's going to replace individuals, no matter where we're prone to error, but we'll mitigate that. But we have to provide the right data into AI in order for it to be a solution. So soon, but not yet.
Eric, those are all really awesome points. And I think it's really critical to not always just talk about the bank perspective on this, but the fintech perspective on it. And I just want to make one point to kind of wrap up what Dana and Brad and Eric have all been saying is, there's a lot to be said about how these relationships are structured, that they're partnerships, and that we make sure that data, you mentioned data, Eric. I think data forms the fundamental basis. Anyone who's ever heard me talk about BaaS, I talk about data all the time. But, being able to have data available to make risk decisioning. So that goes for the fintech side. Do they have information on what the bank's goals are? Do they have information about what the bank needs? Are they escalating those key risk indicators? All of that volume data is really important. Everything that can help the bank to understand the program. Is there a healthy pipeline and communication between the two partnerships? I've seen that consistently break down, where the bank is responsible for having all this information, and the fintech's like, no, this is my business. Why are you asking all these questions? Well, because the bank's being asked those questions, and they can't just go to their regulator and say, sorry, the fintech wouldn't tell us how many transactions they had. So I think it's really important to understand the flow of information and flow of data in these relationships, and that's the sort of endemic not only in the day-to-day, but contract, role clarity, everything. It needs to all be really spelled out. We've got some really wonderful questions coming in from Q&A, and I'm going to pause here and ask a couple of these are really great. Keep them coming. So we've got from the fintech side, when leveraging BaaS, in my mind, building on payment rails of a bank for FIS institution, the contracts are written so the risk falls on the side of the financial institution. Is this worthy of discussion? Dana, I think you wanted to opine on this.
Yeah. So Laura, thank you for the question. Having been on both the fintech side and the middleware side and the bank side, the regulatory risk of having restrictions on your bank charter, that can only be experienced by the bank. So that's why that huge risk always sits with the bank. If a fintech is contributing to problems, they also suffer the risk of their program being limited or their program being turned off. Um, I'm not aware that you could like fine the fintech to pay back for regulatory problems of the bank, but really it is kind of slanted in that way where the bank, its bank charter is at risk. So that's why they need to kind of set up all the controls appropriately. And I think in a good partnership, there can be, a fair distribution of the tasks and the monitoring responsibilities. And to Brad's point, it needs to be priced appropriately. It needs to be priced for the risk that the bank is taking on. But that's my thought process. No matter who is causing the problem, if it's a regulatory problem, it will fall on the bank. And then that problem will trickle downhill to the fintechs if the bank is having their business limited.
We had this little example that we compared. BaaS is like giving your cars to a teenager, right? Except the teenager in this case is that fintech startup or whichever one it is, and that car, that's the federally regulated financial institution, right? And so you got to be careful throughout the entire process to go with. So spot on, Dana.
And there are very smart and wonderful operators on the fintech side. And if you haven't sat in the hot seat as a banker defending your program and every decision that's been made by all of your fintech partners over the last couple of years, you will never appreciate the intensity of that. So I think it's really about, despite, maybe in spite of like all the technological advances and AI and tools and data and all that, I think it really boils down to what is the partnership like? How is the line of communication in between the fintech and the bank? And if that deteriorates, it's kind of like no amount of technology is going to make it work.
That's all really great points. And I am stealing that analogy. That's a really great one, Eric. Brad, I think there's a quick question for you here. And then in the interest of time, I'm going to move on. BaaS is a huge topic, and please, reach out to us, Q&A, Bates Group. We're always happy to talk about this stuff. We're all on LinkedIn. So if you've got additional questions after the fact, just, reach out to us. But Brad, there's, going back to what you were talking about, the go, no go, there's a question here about, it says, Brad, does roll call and ACH say they're a go, debit a go, credit a go, but not meeting compliance in some way? Can you opine on this question?
Yeah, so take off your compliance hat, put on your psychologist hat on this one. And half of my job and half of the head of fintech's job is to get those departments talking together. We force them. It's almost like, making your sister on a long vacation sit next to you in the back of the car. We have to sit in there and hold hands. And so we make each department come together. We have weekly meetings for an hour on Tuesday and an hour on Thursday when we're launching a new program. And we're gonna have to talk, and we have a set agenda with each of the departments of the bank. Biggest I've dealt with is a big 5 bank. I had 62 people on each call because they had 62 approvals that had to get done. But you got to force them to come together, because you're right. Most of the time in a bank, credit's not talking to retail, not talking to debit, not talking to ops, not talking to BSAML. They got to sit in the circle, sing Kumbaya, and we've got to talk through the fintech partnership. And that's a psychology experiment more so than a compliance experiment.
Absolutely. All right. So moving on to challenges during onboarding. So onboarding of fintechs, I feel like we spent a lot of time talking about onboarding of fintechs, but going back to Eric's analogy about giving the teenager the keys to the car, obviously we want to know if that teenager is even capable of knowing their left from their right, or else maybe we shouldn't give them the keys to the car. So we with fintech onboarding, I think one of the biggest pitfalls here, and I think we can continue to use the word pitfall because it really is, it's the same thing over and over again. We're seeing everyone get really excited about these relationships, and fintech is so exciting. We all love what we do. I love fintech. I love all the fintechs I've worked with. Some of my favorite people come from fintechs, and we all get really, really excited. but not cutting that risk assessment and due diligence process is really critically important. Let's see, I think Dana, this is a question for you. I think I can't see my notes. I'm sorry about that, but can someone on the panel maybe give us your perspective?
I just say that kind of my lived experience is that if you're getting red flags during the due diligence
Onboarding.
process, oh, sorry, I think it cut you out. So I would say, if you're getting red flags during the due diligence process, and this goes for both a fintech seeking a bank partner or a bank partner doing due diligence on a fintech, if you're getting red flags throughout the process, please save yourself the pain and heartache later and really dig into that. If someone is, not being forthcoming with information and due diligence, you're going to have chances are it's not going to improve once you've gone live. If you are concerned about a piece of their product, really drill into that and make sure you're comfortable with it, because I feel like the due diligence phase is kind of the honeymoon, and you are absolutely going to go through challenges, potentially big challenges together, even in the best case of scenario. So don't overlook the red flags. That would be my top tip. And then do all the things on this slide.
Brad, do you want to weigh in on that?
Yeah, I mean, it is a really interesting kind of point, which is, are you actually carrying it through onboarding and actually using onboarding as step one of a larger process? And that's the biggest point to make. And I say this all the time to fintechs is, remember, the faster you onboard, the faster you offboard, right? If a bank says, I'll have you live in 6 weeks, they will terminate you in 6 weeks, right? It takes work to make a relationship happen, right? My wife tells me that all the time. Same thing with bank fintech partnerships, right? You've got to invest up front in that partnership, and you've got to build the controls, because you're right, exactly, Dana. That's the honeymoon period when we first onboard, and then something's going to go wrong, right? A year and a half from now, we're going to find out our AML controls didn't work in a payments program. And we're going to have to put in place corrective action program, and you better have that relationship built where you can have those candid discussions. And as the bank, it's important to say, we're doing this to maintain the relationship. We want you to stay live. We don't want to walk when it gets tough. And as a fintech, you've got to understand that, look, every time the bank's asking you for things, that's actually a good sign. If they quit asking you for things, I hate to tell you, 60 to 90 days from now, you're not going to have a bank home, right? Thanks,
Brett,
Robin.
spot on there. I'm glad that you brought that up, because that's been our experience as well. And this goes a little bit to the question of my friend Jose Lapadula there, who put in, are we hiring enough? And this is about that preparation that you were talking about, Brad, right? So when we're looking for, at least in our experience, when we're looking for a partner to go through, this is not 100% outsource. We deal with it with the exact resources that we have. It's what do we need from each side in order to do that? And I had a compliance friend, and she always used to complain. She's like, no one thinks compliance is sexy, but neither is a federal enforcement action. And I really like that component, because it's absolutely true, right? We have to make sure that we have the right people for this, and not just say, yep, we've outsourced, we've signed an agreement, they're managing 100% of this.
So I feel like we could make a coffee mug slogan with that, and maybe it could be something like, compliance, less worse than a root canal, or,
Less worse than a consent order. There we go.
Yeah.
I'm in. All right. Well, we'll think about that. If anyone has suggestions on that slogan, please add them to the Q&A section of this webinar. All right, so moving on, balancing innovation with compliance. This is one of my favorite topics, because I love talking about innovation. I think we all love talking about it. Innovation is absolutely critical. We have to have better tools. We have to be faster. We just frankly have to be better. But a lot of times that innovation injects a lot of chaos, and it's very difficult for a compliance officer or a compliance team to constantly be evaluating new and innovative technologies. And I'm not even talking about the fintechs being innovated. I'm just talking about technology in general. We talked earlier about bringing AI into the mix, which is absolutely critical, but how do you stop when you're already so busy and you've already got so much going on? How do you stop and evaluate a new technology that, frankly, you don't have a framework to evaluate, or we do, but it's model validation, which, the last guidance we got was in 2011 for AI. So it's very challenging to engage with some of these innovative products. But I think that, we can look towards sort of risk framework and risk assessment and research to, slowly start to bring in some of these tools. I think it's important for banks not to go, crazy and just bring in all of these tools and basically take their hands off the wheel. We still need compliance officers. Like we said earlier, AI is not in a place where it can replace us. I don't believe that it will be, hopefully, any time in my career. That would be terrible. But AI it enables us to do our jobs better, but it doesn't do our jobs for us. So understanding that, bringing in this technology and understanding the risks inherent in it and building a structure to mitigate and monitor those risks, that honestly becomes a full-time job. And you need to consider that as part of your staffing strategy, as part of your strategic plan, is not just doing the work you have in front of you today, but how are you going to do the work in front of you tomorrow? Eric, I think you've got some really great perspective on this topic. Do you want to share your thoughts here?
Sure. We learned through lumps and School of Hard Knocks on this one, and so much so that I would even challenge the title of this slide. Balancing innovation with compliance means that innovation is one side, compliance is the other. I would say, how do we make innovation scalable? And that factors in everything across the board. And this, I think, identifies some of the key points that you put here, achieving alignment. So compliance early in product development, we've made the mistake before, at least I have at other firms, there of asking compliance afterwards. We've built something, we have a product, we have a UX, and then we say, compliance, this is okay, right? You're good for doing this. Can we do this by Tuesday? And then we hear a lot of, but what about this? What about the other? Have you factored in? And of course, you don't want to hear it at that time. You're like, it's fine. We'll figure it out. And what I've learned the hard way is if the compliance strategy is we'll figure it out later, congratulations. You just figured out your exit strategy. So bringing the compliance team in, I mean, I think this is like an I would have thought that it's a no-brainer. It's not. I've learned this the hard way, but thankfully, I think that Kraken has it right now, and compliance is one of the key pillars that we have at the ideation phase. And the ideation phase is not so compliance can poo-poo all of the ideas and say why we can't do it. It's changing the compliance perspective of, okay, this is how we can do it, but this is how it's going to be scalably done. And I think that's created something that is much more powerful, much more scalable, and maybe a little bit slower at the beginning, because I know that's always the pushback. It's, but it's going to be slower to go live. At the beginning, as you're getting your traction, possibly, but once you get cohesion, you have subsequent projects, it's a lot easier. People have the same mindset, and we're getting out with something that's going to be a lot more robust.
Yeah, absolutely. Absolutely. I love that idea of, compliance being part of a product build. It's honestly, it's one of the funnest things I get to do as a compliance professional. It makes me better at my job. It also helps me mitigate risks on the back end too. So great points. All right. So moving along to compliance risks and bank responsibilities. So there are some compliance risks and bank responsibilities inherent in BaaS. Dana, can you give us your perspective?
I wouldn't really have much to add to this. I think we've already discussed that the bank ultimately has the regulatory liability, no matter if the banker's doing the activity, the middleware technology platform, or the fintech. We still have our bank charter on the line, and we're ultimately the ones going through the exams. So I think we've pretty much hit these today.
You're just ahead of the game. Okay, I will move on then. Third-party oversight and automation. I think we've talked a lot about this, but Dana, do you have anything to add here?
Again, I think when you're managing multiple different fintech partners, having some sort of platform where you can work collaboratively with the fintechs is a must-have if you want to try and do this in any efficient manner. And again, I'm not going to name the brand name of the GRC platform I use since this is a Bates webinar, but There are some great solutions out there. For instance, when my fintechs want to post marketing content, they will upload it to the collaborative workspace. I can put little notes specifically on it. It will ping them and request the review, and they can make those changes. And it's all in an auditable format. Nothing's happening in email. We have kind of all the rest of our risk assessments, our policies and procedures, our complaint tracking is in there, our audits, and it's a really great way to track KRIs, reporting for our board, and just kind of having that system has been really helpful. And then also leaning into other types of automation. You put here around due diligence. There's a lot of control testing stuff that I see cropping up. And I'm really interested in figuring out how to get more continuous control testing, potentially using AI or just setting up our data in different ways. Because again, like there's so much risk to manage. And if a computer can do it or get more coverage, like I want the computer to do it if it's doing it in a sound manner.
And Robin, just really quickly to kind of on what Dana just said, this is the one exception to my rule of we run this like mission control and we go around the circle. You need someone who is in charge of overseeing each of your fintechs, right? Who is the SME for that fintech relationship. And that person needs to know deadlines, needs to know the compliance and monitoring schedule, needs to have testing schedules, need to be on top of deadlines for audits and NACHA audits and BSAML audits and everything else that comes in, fair lending testing. And that individual needs to be writing that fintech to get that information in and have it documented. Just like Dana said, for gosh sakes, you've got to get off email, right? Whatever system you're going to use, email poisons banks when it comes to fintech partnerships because it's viewed as informal. Little Brad sitting down as a first level compliance analyst is going to say something's okay, and it's going to kill your program when it didn't get escalated to Dana sitting in the big seat in the corner. And then three, if it's not documented, it didn't happen, right? How many times the FDIC told us that over the years?
Yeah.
Spot on.
you're-
I think this highlights the issue that we've seen. And I remember, so Dana, you mentioned 2014 when I first moved into fintech. There was the executive management style of move fast and break things, right? I think we've shifted away from that. And especially when you're dealing with regulated entities and all reputational risks, that break things component can be replaced with move fast and automate what you can in order to make sure that it's sustainable.
Absolutely. And there's one major point that I want to make on third-party oversight as well, but I think some banks do it well. I've not seen a lot of banks do this entirely well, and that is, understanding that your fintech performs multiple functions for you. They are a marketing affiliate. They are a payment processor. They are sometimes your BSA outsourced compliance. They're doing all of these different things, Reg E, complaints, all of these different functions are third-party functions that if you think about this in the context of the regular bank, you would have multiple different parties doing that. You would have a separate processor, maybe a separate, loan underwriting system. But one of the interesting and challenging things about fintech is you get this convergence of multiple types of third-party risk in one single relationship. And it's really critical. Brad mentioned having one person to oversee the relationship. I think that is absolutely the right way to go. But I also think that making sure that the bank's vendor management, third-party management, it has to be commensurate for your fintech partnerships and probably, if not through the same process, through a similar process where if you're evaluating a payment processor for the bank and you have a set of standard due diligence that you're doing there, you need to apply that same standard to your fintech partner. And I think this is often missed, where we focus. And I think sometimes the consent orders have actually muddied the waters a little bit here because we focus so much on BSA and we focus so much on compliance, but there are other parts of compliance that present risk in these relationships that have knock-on effects to other parts. So let's say that your fintech partner as a payment processor is having issues that can present as BSA risk for you too. And that's not typical in a standard banking relationship. That's sort of like it's almost, just a hyper speed of compliance. And so we have to kind of think outside of just BSA, just credit, just, operational risk, and really think about it as what are all of the types of third-party risks that are inherent in here, and make sure we're covering those under that single point of contact and in the contract. Make sure the contract completely elucidates who is doing what role they're playing, and the contract will probably state that they have those multiple roles. You have to apply those same standards, and you have to incorporate that into your enterprise risk management framework. So it has to go all the way back up the chain.
And Robin, kind of on that point, don't confuse the fact that so many formal agreements on the payment side focus on BSAML and on the lending side focus on fair lending and model validations, with those being the problems. If you think about it, those are the only two developed sets of regulations that regulators can point to and test against, right? Because we still don't have true guidance on third-party risk management. We have all these kind of general aspirational statements, but we know how to test for fair lending. We know how to test if you're doing BSAML. And so it's the easiest thing for a set of auditors or regulators to criticize you for. Don't drink the Kool-Aid, right? That's not the only problems. That's just the easiest problems for them to flag.
That's a really, really great point. Really great point. Because usually if there's one thing wrong, it's probably more than just the one. All right. Any other thoughts from this team about third-party oversight? It's my favorite topic. So okay. All right. I would love to hear from the whole group about strategies to future-proof compliance, because I think that one of the challenges in the role that we have, and the role of banks play and fintechs and everything, is everything moves so fast. It is growing. We see in fintech, we talk about the hockey stick, right? We may have sort of managed growth on the bank side, but a fintech can grow so fast. And that can just really introduce a lot of risk, where if you're not scaling appropriately, your bank's not considering your risk. I mean, we're seeing fintechs disrupt bank liquidity, which is insane to me. But when we've got a lot of these small banks, when that hockey stick happens, you can have some major liquidity issues. You can have credit issues, you can have all these things. So, we have to make sure that we're considering how to future-proof our compliance programs. Would love to hear from the panelists. I'll start with Dana. Would love to hear your thoughts on how you future-proof compliance.
I view part of my role as a compliance leader, and I'd invite the rest of you to also consider this. I view part of my role as a compliance leader to be constantly learning about and evaluating new technology that could help my department. So I have a portion of my time allocated to meeting with vendors, having conversations, understanding what is out there, because the risks are always increasing. And I feel the need to figure out ways to continue to streamline my operations so that I can be more effective to manage those increasing risks without increasing the dollars spent constantly on headcount. So I think all of these are great tips, but definitely lean into all things AI, all things automation, and get yourself a great governance, risk, and compliance platform.
Brad, I would love to hear your thoughts on devoting adequate resources, or perhaps I think you've seen a lot of not having those adequate resources as a scalable strategy.
Yeah, and that is price this as a financial institution. As a fintech, expect that pricing. And part of that is, I use the example of, I was working with a small 17, 20 branch bank. They opened about 10,000 savings accounts a year. They partnered with a giant brand, and suddenly they opened 100,000 savings accounts in the first week we went live. And think about how much you need to scale then your deposit ops if you went from opening 10,000 savings accounts a year to 100,000 a week, right? And do you have broker deposits you can, put into network? Have you thought about these edge case scenarios, these black swan events adequately at your planning phase? But you also need to make sure that as you're writing your contracts, don't put yourself in this fight where, to maintain the profitability of this vertical in your bank, you're having to scrimp on compliance, right? I mean, look, that's not to say go out and spend $5 million on lawyers, though that's a good feeling to do that. But and then spend 50, hire 50 FTEs to supervise this. But if you're running 10 or 12 fintechs and they're doing anything that's not vanilla payments or vanilla prime retail lending, you're going to have a very aggressive, scalable department that is unique for those risks, right? And you can't scrimp on that because almost every one of the consent orders and formal agreements I've worked on has been small bank got in over its head, did not have resources or subject matter expertise for that risk vertical of that fintech, right? You get a community bank and they're talking to somebody like Eric who knows, more than anybody else in the world when it comes to digital assets and crypto assets. And then you've got, little Brad who's sitting in the back of the compliance department of a 3-branch bank saying, hang on, tell me again what Bitcoin is and how it's different from Ether, right? You got to scale appropriately. You're going to have to hire Erics to be in your bank if you're going to try to bank Kraken, right? You need that corollary expertise that grows with that relationship.
I get that question a lot, by the way, Brad. What's the difference between Ethereum, Bitcoin, stablecoin, whatever the case is? That's a 101. My perspective on this is it's very similar to any type of relationship that you're building, and you start with a foundation and even the definition. So Kraken's idea of BaaS is we define it as banking as a service. We don't define it as bankruptcy as a solution, for example. So you have to think about that as we're building something like this in place. The next one is communication.
Wow.
Once we have it in place, right? So let's say we're following all of these pieces, and Dana, Brad, I agree with you guys about the scalable frameworks, technology, and all. But once we have this in place, communication is essential, and making sure that compliance has a seat at the table for that, whether it's QBRs, whether it's evaluations, whether it's constant optimization to make sure that this truly is scalable, it all comes down to communication. This isn't you sign an agreement and let's hope it goes through and let's hope the bank is doing what they're doing and the fintech is doing what they're doing. It's making sure that kind of what we discussed before about it's okay to fail quickly, even though failure stresses me out a little bit. It's all right, well, let's identify it, let's mitigate it, and let's make sure that any other potential future issues are mitigated as we do this as well there. And that all comes through communication.
Great points. We are coming to the end of our webinar today. I would love for each of the panelists give us maybe your top line takeaway for the day. Keep it, real short and sweet. I think we're going to get some great taglines from Eric. It seems like he's got the soul of a poet over there. But would love.
I'm glad I was on mute because I was cackling at that last comment, Eric. Robin, if I can just jump in. So my 2 top tips are, the first is, might be surprising, but it's actually empathy. Where does empathy fit into this? I think that if a bank partner can truly understand what a fintech is going through, the urgency of them needing to prove themselves to become a viable business, perhaps on a short runway, the passion and dedication that they have to make this thing happen. And then if the fintech perhaps extends some empathy to the bank partner to understand what it takes to be a pillar of the community and how much blood, sweat, and tears goes into maintaining a bank charter, it's only going to support the relationship. And the second tip is have an ironclad contract in case it does not work out, just so that everyone's clear. So thanks so much for having me on this call today.
Right, final words from our other 2 panelists.
All right.
I'll go first because I want to have Eric go last because he's going to leave us with a gem in a second. My takeaway from this is, one, regulators are becoming more sophisticated. They're not going away. That's good for all of us because they're learning about bank fintech partnerships. But at the same time, just understand it's hugely profitable, right? The moat around the island's getting deeper. It's harder to get on the island, but if you can build these programs, the next 4 years are insanely profitable for your bank if you can get on the island. But it's a lot harder to swim across that moat, and it takes investment, it takes resources, it takes subject matter expertise.
All right, Eric. Final thoughts. What do you got for us?
Okay, so a serious one and a soft one there that I'll share. Banking as a service and the structure that we do should follow the exact same methodology that a company is thinking about any type of partnership. make sure it's scalable, make sure that the right people are in the room as we ideate and as we execute and as we follow up, kind of like what Brad had said about checking through. And then yesterday I had a dentist appointment, and I thought it was kind of funny that if I correlate compliance to flossing, it's not something that you do right before the checkup and you're like, oh, I got a meeting with a regulator tomorrow. Let's get the compliance team in place. It's build it from the get-go. Make sure the compliance has a seat at the table. It makes it a lot easier to go through.
So what you're saying is we should floss more than once a year.
Daily.
All right.
Exactly right.
And there you have it. I hope everyone has enjoyed our webinar today. Please stay tuned as we do have additional webinars coming up. So hope you will join us in a future webinar. Thank you for everybody who participated. Thanks.